and welcome to Market Domination. It is Friday, April 11th, the last trading day of the week, and it's been a week. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We've got 1 hour to go to the market close. We're seeing more swings today, because of course. So right now, the Dow is up more than 500 points. We're a little loopy here at the end of this week, up about 1.25%, excuse me. The S&P 500 up by nearly 1.5%, and the NASDAQ is there. But I do want to linger for a moment, Josh, on looking at this week that we have seen. Because when we talk about volatility, and this doesn't even give the full scope of the intraday moves, right? We have to go to kind of the candlestick to get all of the wild moves that we've seen over the course of the week. What's interesting is we're up on the week by more than 5%. This is the best week we've seen for stocks in a little while, even though it doesn't necessarily feel that way because of all the volatility.
It's been a wild week. It's been a historic week, really, Julie. A couple headlines that hit the tape this afternoon that I think helps explain the moves we saw. We saw a headline hit that President Trump optimistic he can get a deal done with China. This was according to the White House press secretary. You also then saw Susan Collins hitting the tape. She's the head of the Boston Fed, and she was telling the FT that the Fed is absolutely ready to step in and help stabilize the market if necessary. And I think investors assume that, but it's nice to hear as you head into the weekend.
Yes. Yeah. Let's look at some of the other asset classes that we've been watching so closely this week. We got to look at what's going on with yields. Because
massive moves this week, right?
we are seeing an upward move in yields again. So this is not necessarily what the markets or what the White House wants to see. They want to see perhaps yields come in a little bit, but we'll be watching the 10-year really, really closely at these levels. I know you have had your eyes squarely on the U.S. dollar, which has been sort of breaking down. It's back above 100 if you look at the dollar index.
Yeah, I mean, some of the selling abating in treasuries in the dollar, I think it helps explain the move in the stock market today. I also, just to quickly touch on the economic data we got today, Julie, which was interesting. PPI was good. Consumer sentiment, not so good.
Right. So it's sort of in line with what we have been seeing, the trend that we've been seeing as of late, where, as we talked about with a couple of guests yesterday, the Fed got so close to the soft landing, and now sentiment is really pushing down on and putting pressure on the hard data that we're going to start to get that may be affected by that. So we're still keeping a close eye on all of that. Getting back to stocks here and what we're seeing today in terms of groups, broad-based rally that we're seeing today, materials and energy and tech up the most here. Let's look at that versus what we've seen over the past 5 days. Real estate in the red on the week, energy barely in the green, but tech and industrials, the two big outperformers that we've seen this week.
Let's talk more about these markets, because we're joined now by Mike Dixon, head of research and quantitative strategies for Horizon Investments. Mike, it is good to see you. I thought it was interesting, Mike. You say in your notes there that global diversification, Mike, that could be, you say, the new Mag 7 trade. What do you mean by that, Mike? Walk us through it.
Yeah, what a week. This is the kind of week you just wish there was a 3-day weekend involved on the other end, right? But when you look at the what I mean by that is that the Mag 7 trade has definitely been challenged. It's an area of the market where valuations were kind of priced to perfection. And here we are with just massive uncertainties. And that increase in risk premium, has definitely seen that segment of the market really suffer. And even before, just this last week, we saw extremely strong performance from international stocks to start the year. This is very consistent with what we saw in 2017 during Trump's first term. And it's just a reminder as well with the strength that we've seen, that global diversification, is back. And with a lot of areas of this kind of move away from the U.S. exceptionalism trade, that's where international stocks, begin to look a lot more attractive. You've got a lot different sector makeup, a good bit lower valuations, and I think really poised to be a place to put capital when the top of the market in the U.S. here is struggling and under stress.
And we've already been seeing that move to some extent, right? The move into international, the move into Europe in particular, Mike. It sounds like you think that move has more legs. And does it come at the expense of capital moving into U.S. equities?
Well, I think when you look at where capital has been moving, right, just looking at international versus U.S. stocks, looking at the moves and yields, looking at the moves in the U.S. dollar, all of these really point to a coordinated move away from U.S. assets. And I think that is a trend that is likely to persist here in the short to medium term. And again, is a trend somewhat consistent with what we saw during the first term with President Trump. And that is an area of the market that's been very ignored for quite some time. And I think that, along with, even inside of the U.S., just the rest of the market, right, the broadening out, we've seen that be very strong thus far to start the year. And I really think that broadening out trade, both in the global international space, as well as the more equal weight sectors here in the U.S., is kind of like the new core portfolio to think about, as opposed to just the pure Mag 7, which is what it was in 23 and 24.
Mike, I also want to get your take on another big theme, which was clearly these moves, these massive moves in the bond market, Mike. And the reason or reasons you think that explains that is one, do you think, Mike, because investors are trying to think through what could be tariffs-induced higher prices coming at us?
I think so. I mean, there's a couple, a couple areas you could point to. I mean, one of them is, let's take China, for example. Obviously this trade war is pretty much exclusively about China at this point. I think that was made pretty clear this week. And with that, that's put, a lot of stress on, and expected to put a lot of stress on, Chinese exports, and as a result, you could have been seen, and what a likely driver would be selling U.S. treasuries that China owns in order to kind of prop up their currency. That could be one of the drivers that we've seen, and also when you look at other areas internationally, let's take the Eurozone, for example. They are very large holders of U.S. paper, and you could see selling some of the U.S. treasuries to basically, invest in more domestic bonds from their perspective, as also another source of a lot of this selling. But like you said, I mean, it has certainly been quite odd to see some of these large moves that you would not kind of expect up front. But I think those two things are some of the main drivers that are likely in the works, causing these moves in longer term yields.
Mike, obviously sentiment now is kind of in the pits, right? Whether you're talking about consumer sentiment or investor sentiment, for that matter, even despite, rallies like the one we saw today and 2 sessions ago. When you look over the longer term, if you're talking to a client who has clients, or who is someone who's going to be retiring in, say, 10 years or more, or even 5 years or more, should they be less worried? In other words, is the longer term uptrend in U.S. stocks still intact, or is this something that is a more profound reworking of the typical economic cycles and market cycles that we see?
Yeah, for somebody with that type of horizon, I don't think this changes things. I think if anything, for the average person working with an advisor, kind of building a financial plan, this is a very stark reminder to take a look at your asset allocation. Make sure you're properly diversified. I think the last couple of years with the concentration in the Mag 7 that we've seen, just a pure passive style of investment has folks really over-indexed to concentrated, high valuation areas of the market. And, they've probably had, if that was their situation, a rough couple weeks for sure. So it is certainly a reminder to make sure to stay diversified, even if that doesn't appear to be the most popular trade at the moment. But, also when we think about longer term, the overall, starting place for the U.S. consumer and the overall economy, the consumer balance sheets, that data looks really strong. And while this might challenge some of that, consumer spending power here in the short term, the starting place is from a really good place. And I think that's really important to keep that perspective, as we hopefully, get some of these negotiations to a resolution soon.
Mike, thanks so much. Appreciate it.
Yep. Thank you.
We're just getting started here on Market Domination. Coming up, big banks have been reporting. What tone are they setting to kick off earnings season? We'll discuss. And Yahoo Finance sits down with Boston Fed President Susan Collins to talk market uncertainty. You'll want to hear what she has to say. Plus, business at Tesla is not business as usual. We'll have all of those stories and more coming up. Big banks kicking off another earnings season this morning. JP Morgan and Morgan Stanley headlining the reports with solid beats against the backdrop of looming economic uncertainty. For more, we're bringing in Ken Leon, Director of Equity Research at CFRA, covering the banking sector. Ken, it's always great to get some time with you. And there was a really fascinating disconnect today because, indeed, most of the numbers from the big banks, writ large, were pretty decent, especially things like equity trading revenue. But what we were hearing in terms of the commentary from the banks maybe is leading us to buckle up a little bit for the rest of the year. Is that how you read it?
You know, I've been covering these large banks for 20 years. By far, the rock star was Ted Pick, Chairman, CEO, Morgan Stanley. He did not buckle down. He was confident about the opportunities Morgan Stanley has and the business. And even if they have 75% of their revenue coming from the U.S., they're going to continue to enrich and expand outside the U.S., including Asia. So that to me was by far 5 stars. Jamie Dimon was a little bit more cautious, mostly because I think, there is some concerns from the geopolitical risks that we all know about.
Well, what about the macro, though, Ken? To the extent that, we see a slowing U.S. economy, maybe even a contraction, that means what for your coverage universe?
Yeah, so we look at all the dials and, the one would be Main Street, whether it be the consumer or small business. The consumer, we are seeing a slight uptick in terms of loan balances for credit cards, but nothing in terms of delinquencies that is alarming. And we look at all the banks every quarter. Secondly, for small business, we're not seeing anything that would, at this point, suggest that the businesses are not viable. And as it relates to corporates, they're on the sidelines, as is financial sponsors or private equity. They're both needed for the capital markets. CEO confidence probably is lower. They're not really sure how much they want to commit for capital and go to the markets. I think the consensus of analysts is it's a second half story. It reminds me when we were in COVID at the beginning with the capital markets and investment banking. And by the way, the only thing that was down a lot was equity underwriting. M&A and debt underwriting was still double digits and positives. But what reminds me of that time with COVID, whether an analyst would say, in this case, second half 25, is it going to be V-shape or U-shape? And that's really what we're playing around. If you're really bearish on the geopolitical scenario, you're saying that things are not going to be good for all this year, and I'm going to be conservative. Maybe there's an uptick next year. I don't think that's the case. What we got in the results, I think, is certainly that these are durable, great franchises. For investors, they represent core holdings. And the other aspect, we're overweighted on the financial sector, is that many of these banks have more durable recurring revenue from wealth management and asset management and some principal investments. So, yeah, are we concerned? Of course. But these are some of the best franchises we have in the United States.
Now, what I'm hearing you say when you talk about durable recurring revenue, when you talk about not seeing a big alarming uptick in delinquencies, all of that sounds like stuff is okay, but it doesn't imply that V-shape that you're talking about, right? We did hear, I know you don't cover Wells Fargo specifically, but Wells Fargo did indicate there was softening demand for loans. So where does that growth come from? I mean, I get your message that these are solid, but solid and growing are two different things, obviously. So where is that going to come from?
Yeah, and my colleague covers it, Alexander Yoakum, but I covered them for 15 years. And I think Wells Fargo, their softness might be in the middle markets. But again, it's going to have to be that slingshot is going to be coming from corporates, large corporates, CEOs, multinationals, and financial sponsors. We have $1 trillion that has to be monetized from the private equity firms. I cover the big 8. There's only 3 analysts that cover the large banks and private equity. And it was beginning to improve last year, and then the brakes hit. So their success is dependent on an exit ramp of either going to the market for IPOs or perhaps selling those businesses. And these are all really smart management, successful firms. We're going to get Blackstone next week, Steve Schwartzman, CEO, and that's going to be the next read. But that's my slingshot. It's not Main Street or Middle America. I personally, at this point, because there's been interviews along the last day or two, do you want to be in traditional banks or investment banking's capital markets? I'd rather be in investment banks, capital markets. They're both good. I just feel I have more of a delta on the fundamentals, and that's going to be a driver for alpha of the stocks.
Ken, finally, let's just push ahead here because we got Morgan Stanley today, got Goldman on Monday. What do you expect to hear there, Ken?
Goldman should be more like Morgan Stanley. I mentioned these words, which, for Goldman Sachs, durable recurring revenue. They did have a failed strategy, as you recall, looking back to retail consumer finance. So it's all about the core franchise and making principal investments, sometimes competing against the private equity firms, also going in and as an agent or doing private credit. So we're beginning to see Goldman Sachs try to level off that cyclical volatility. Of course, you can't do it in the world we're in right now. And the reason you want to do that is it gives them a chance to kind of get multiple expansion in their stock, as Morgan Stanley was able to do, or try to get as high as BlackRock. That's the strategy. It will work, but right now, we have the external factors that put a lot of pressure.
Thanks, Ken. Great to see you. Have a good weekend.
You too.
Let's take a look at today's trending tickers. We got Recursion Pharmaceuticals, Intel, and Five Below. We'll also check on a few other names moving along with them. We want to start with Recursion here. This stock has been near the top of the trending tickers list on Yahoo Finance all day. The company works on biotech AI models, and the stock's extending its rally for a second day after the FDA said on Thursday it plans to phase out animal testing requirements for monoclonal antibodies and other drugs. So what does that mean? It means there is going to be less animal testing. So other companies like Charles River have been plunging that facilitate that testing. And then there's speculation that companies that are trying to offer an alternative to that testing by doing AI models, for example, those stocks have been soaring.
Yeah, I see analysts weighing in. Team at RBC side is saying these steps towards increased regulatory flexibility, net positive, they say, especially given recent concerns about potential FDA dysfunction, potentially greater stringency. See Barclays, they weighed in as well, taking out preclinical animal testing. They talk about a good goal. Questions, though, here on feasibility and implementation remain, they say.
Right, and that Charles River plunge is something as well, and analysts are commenting on that. Baird analyst Eric Caldwell talking about this, saying the players in this industry likely won't fully recover when it comes to valuation. He called today's news, or yesterday's news, I should say, shock and awe on this front.
All right, moving on. Let's check out Intel here because that stock, along with Texas Instruments, moving lower today. It's after the China Semiconductor Industry Association released an urgent notice regarding the criteria for determining the origin of imported chips, which could heighten trade tensions between the two nations. So you did see some of these chip makers, specifically those with manufacturing footprints, under some pressure. China, we know, of course, hit back, announced these new tariffs going after semiconductor imports. The tariff raised, we know, in all goods to 125%. Those are going to be determined where chips, sounds like, Julie, are manufactured. So then you did see, no surprise, some of these names kind of a bit of pressure today, specifically Intel, Texas Instruments. I did see analysts at Baird, though, cited as talking about how TI shares, they thought were overreacting to the news, that its shares in China could erode somewhat, but they were saying it benefits from product performance, product breadth, cost structure, customer service advantages, which would be difficult, they said, for Chinese OEMs to ignore altogether.
Yeah, I was looking at a note from Jordan Klein, our buddy over at Mizuho, who's on the desk there and writes all about tech stocks every day. And he said basically this is bad news for companies that manufacture chips in the U.S. and want to try and export them to China, like an Intel and a Texas Instruments. He said conversely, this could be good news for companies that design their chips, don't make them here, but make them in effect TSM makes their chips for them. So
like
Qualcomm,
a certain Jensen Huang,
yes,
perhaps?
Nvidia, a Qualcomm, an AMD, and indeed those stocks are performing better today.
Nvidia, nice pop today.
Yeah. Our next trading ticker is Five Below. Those shares have been slumping. The retailer asked vendors to turn away products waiting for shipment in China before they set off for the U.S. This was according to a memo reviewed by Bloomberg here. And this was the intermediary here was Müller-Maersk, which is the shipping giant, which sent this note to some of Five Below's vendors. It's unclear if it affects all of the vendors or just some of the vendors, but this really gets to the heart of what this tariff ripple effect is going to look like.
Yeah, China is Five Below's largest source of merchandise that it imports. Bloomberg, citing Oppenheimer, is saying tariff increases could pose costs of 90 to 95% for Five Below. And I just look at the chart of this one. I mean, it's just rough. I mean, Five Below, we're down here about 60% now over the past 12 months.
And Josh, you know what this story reminds me of? It's we've had this whole debate about how much this is going to push up prices on items in the U.S., but there's also a growing chorus that is saying it also could just mean we see COVID-like shortages where we just don't have. It's not that the prices go up; it's that you can't even get the thing that is imported from China. So that's something to continue to watch.
Another dynamic. All right, is the U.S. still number one? We're going to take a look at the concept of American exceptionalism when we return. It's a conversation you don't want to miss.
Boston Fed President Susan Collins sitting down with our own Jennifer Schonberger earlier, getting her perspective on the tariff uncertainty and implications for the economy and the Fed's mandate.
Susan, you mentioned that it could take a couple of years for inflation from tariffs to really filter through our economy. We know that there are going to be tariffs on intermediate goods filtering through our supply chains. How are you thinking about the prolonged effects on inflation?
Yeah, so typically if you have a tariff put in place and it's maintained over the longer term, I would see that as causing a change in price levels, and it's the adjustment to that new price level that is what gives you the inflation. But if it takes some time for that adjustment to happen, then the persistence of the inflation is going to last for longer. And there are a number of factors in that in terms of how firms do the pass-through, how various other kinds of adjustments are made. But as I've talked to both large and small employers and firms in my district and looked at some of the results of surveys of small businesses, what I'm hearing and we're seeing in those surveys is that many firms expect it to take longer to really factor through what their own pricing looks like. And so I am rethinking my initial view that it may only take a couple of months if the tariffs were to be kept at a certain level. And then, of course, we know the tariffs have been evolving, and so that can have an impact as well in terms of the persistence.
So do you think that inflation could not just increase for this year, but persist then through 2026?
So, I would, it's early in the year, and so if it takes a year plus, my kind of modal outlook, again, don't know how to factor in continued changes in the tariffs. Would that be that into 2026 we would start to see inflation begin to moderate? At the same time, one of the things I would be looking carefully at was not seeing expectations become unmoored, which would have broader implications for price setting, and that would be more persistent, and that's something that I would take very seriously as I think about policy.
Do you worry about stagflation?
Well, I certainly am concerned about both sides of our mandate. And as I mentioned, my expectation is slower growth combined with higher inflation. And we'd be looking at both sides of that. I think that can be a complicated challenge for policy because, with slower growth, if growth slows dramatically, you would want to ease, but with higher elevated inflation, it's really important to maintain the restrictive posture. So how to balance those is certainly something that I think about and is something that we would have to navigate as the economic conditions became clearer.
You mentioned you're watching the financial markets closely, and the Treasury market has been on a wild ride over the past week and a half. What are your takeaways from that? Are there implications for your balance sheet and how that's being managed? Obviously, the runoff has now been slowed down. Could we see changes on account of that? And what would it take for you to intervene in the Treasury market?
Let me say a couple of things about that. Maybe I would start by saying that the markets are continuing to function well. Liquidity has been maintained. That's something, of course, we're watching very carefully, and we do have tools to intervene if there were concerns in terms of market function or in terms of liquidity, and we are absolutely prepared to move as appropriate in those circumstances. You know, we did slow the pace of runoff recently, and I think that positions us well to continue normalizing the balance sheet in a steady way that does not contribute to some of the market changes that we've seen. But again, it's something we'll continue to watch carefully. But I think we're well positioned in that context, as we are in terms of the policy stance for monetary policy.
Do you worry that the tariffs could somewhat sully the reputation of the U.S. and hurt foreign demand for U.S. Treasuries? That's been a concern in markets this week.
So there are a variety of things that could influence, financial flows and demands, and we continue to try to assess how things are evolving. And at this point, it's very difficult to parse out particular pieces of what impacts some of these many considerations could have.
And before we wrap up, you've said that you need to see inflation start to come down before you would normalize policy. The markets are factoring in a rate cut in June. Too soon?
Yep. So what I would say is I think we're well positioned. We need to look at both sides of the mandate. I would be looking for more confidence that we were back on that disinflation trajectory, of course, unless we are in a more adverse context. Not my baseline. Again, there is quite a bit of strength in some of the underlying fundamentals of the economy, and policy is well positioned to react as appropriate.
And Jennifer is joining us now. Jen, a really interesting interview here, and obviously a very interesting moment for the Fed, as for many people. But what were your sort of impressions and takeaways after that conversation?
Thanks so much, Julie. It's great to be with you. And again, just want to extend my gratitude for Susan Collins for joining me earlier this morning. Always appreciate her insight. You heard her answer to my last question, where she essentially poured cold water over the notion of a rate cut in June. And we've seen markets price in now, I think it's about a 64% chance of the first rate cut that they see this year in June. She now sees holding rates for longer. And for those of us who closely watch the Fed and closely watch what she specifically says, she actually changed a little bit of her language and is taking a more cautionary view. She said that, quote, it may still be appropriate to cut later this year. Beforehand, she had said likely. So that's sort of a step back right there. And Julie, really what the Fed needs to see, what Collins told me she needs to see in order to cut rates, is for certainty over, or more surety over, inflation being in check and long-term inflation expectations also remaining in check. And she had an assessment from the Boston Fed that showed that if the effective tariff rate is just over 10%, they would expect inflation to be well over 3% just for this year. And we know with the tariff rate on China being 145%, that the effective rate is probably double that. So we could see even higher inflation potentially from that this year. And as far as expectations over the long term when it comes to inflation, you saw that University of Michigan survey out today where inflation expectations over the next 5 years have jumped to 4.4%, the highest since 1991. So a lot of caution coming out from the Fed right now.
Jennifer, great interview. Thanks for bringing it to us.
Thank you so much, Josh.
Well, since the 2008 financial crisis subsided, America's economy has been the envy of the developed world. Annual average real growth in GDP has been twice that of Europe and Britain and more than 4 times that of Japan. But can America's economy stay exceptional? Our next guest says the answer is no longer a clear yes. Joining us now is Rebecca Patterson, Bridgewater Associates' former chief investment strategist. Rebecca, it's good to see you. So let's get right to this op-ed, Rebecca. So can America stay exceptional? The answer, you say, is no longer a clear yes. How come, Rebecca? Walk us through it.
Sure. Well, there are certain things that I think are clearly still exceptional. We have an innovative culture relative to many peers. We have a lighter touch regulatory system. I know some would like it even lighter. We have a strong educational system. We have a growing labor market, although at a slower pace. So we have some bedrock foundations there that I think are really important. What I worry about are some of the things being chipped away at. They're not gone, but we should just be cognizant that they're being chipped away at. Things like research and development. If we're taking away government funds and other funds to support the innovation, it's the innovation that's driving the productivity growth in the United States that helps keep our GDP elevated. So that would be one factor. On immigration, I think everyone agrees we need a clear immigration policy. We need border control, but we also need to make sure we have enough workers. When you think about manufacturing, both parties want to have a strong manufacturing sector, but a lot of the manufacturing jobs today, before we reshore, are going unfilled because they can't find enough qualified workers. So we want to make sure we don't throw the baby out with the bathwater, so to speak. It's probably a terrible analogy, excuse me. But we want to make sure we have enough people here to do the jobs of the future and that they're trained appropriately. So that's another piece that I'm a little worried we're chipping away at. And then finally, what we've been living through for the last week or so is just the trust in the global system in America as a reliable partner. Foreign direct investment to the United States creates millions of jobs, and we need to make sure we keep those partnerships so companies and countries continue to want to put money to invest in the United States and to buy our assets. I know that the dollar is overvalued today. We would like the dollar to be somewhat weaker. However, all that capital coming into the U.S. pushes up our stock prices, holds down our borrowing costs, and that contributes to household wealth, which then allows Americans to spend, companies to invest. So we need to make sure everyone is participating in that, but we also don't want to end that cycle because overall it's been a pretty good thing.
Rebecca, how close to the point of no return are we in terms of American exceptionalism? Like, what to you is this sort of tipping point where it's done?
Well, again, there's 2 ways we can lose exceptionalism. We can go down or others can go up. And I would say something that I'm watching with a lot of interest is what's happening in Europe today. Partly thanks to a push from the United States government, Europe, for the first time in many decades, is loosening its purse strings. They're increasing spending significantly on defense and on infrastructure and in research and development. That could support their growth and present the United States as, an alternative as places to put your capital. So I think it's worth watching what's happening overseas as countries respond to the U.S. I do think the longer these tariffs last, the longer we have policy that seems somewhat intuitive rather than strategic and laid out thoughtfully. When we tell our allies and our partners that we want to acquire them as a state, these are things that lead the G7 to become the G6+1. That is the outcome that the United States does not want because it means we're going to have less capital coming to our country, investing in our companies, creating those jobs we need. I don't think we've crossed the Rubicon, but I do think we need to keep a close eye on it. Clearly, the last week, we have seen foreign investors taking their money out of U.S. assets. It's one of the reasons you've seen the dollar lower, bond yields higher, and stocks lower.
Rebecca, one important theme for investors, and I'd love to get your take on this, has been the mega AI trade and trend, right? AI hardware, AI software. America is exceptional when it comes to that, Rebecca, truly in pole position. Do you expect that to continue?
I think it will, and I think it's one of the most important supports right now for our economy. The fact that these mega cap tech companies have so much free cash flow, they can continue to invest in their own innovation, and those investments do create broader GDP growth. So that is somewhere that it helps us stay exceptional. At the same time, I wouldn't just ignore what's happening in China. China is now graduating many, many more STEM PhD students than the United States. They have been doing so now for well over a decade. So it's not that we're the only game in town. I do think we're the strongest game in town, but China is spending a lot of money and resources. The government is doubling down to make sure that they can have a very strong tech sector too. So I wouldn't get arrogant, I guess is what I'm saying, but I do agree with you that it's a source of strength for us structurally and cyclically.
Rachel, thank you. Appreciate it. Or
Have a
Rebecca,
good Friday.
Excuse me.
Yeah,
Thank you.
that's okay. It's been a long
Rachel
week.
in my ear, Rebecca in front of my face. Sorry about that. Thank you.
It's all good. Bye.
Well, Tesla shares slipping as it stops taking orders in China for 2 models imported from the U.S. The EV maker feeling the sting from the tariffs on China. Yahoo Finance's Pras Subramanian joining us now to discuss. So, Pras, obviously we've seen a big ripple effect from what's going on, and this the latest example from Tesla.
Yeah, you saw these retaliatory tariffs in China, 125% tariffs for U.S. Imports coming into China, which makes them not competitive, right? So for Tesla here, their higher end models, the Model X and Model S EVs, both made in California, have been pulled from the Chinese market per Tesla's website. These cars cost around $100,000 US dollars or equivalent in China, and it would cost double the amount if the tariff would be placed on them, so which is untenable for them at that point. So, Tesla sold around 2,000 of these vehicles last year, so it isn't a big mover for them, but it sort of highlights the precarious situation that Tesla and other automakers find themselves now in this post-trade war world.
And Pras, new lower price Cybertruck, my friend, is out. What are the details there, Pras? And could it help demand?
Josh, I know you're looking at a pickup truck yourself, but not saying the Cybertruck would work for you, but the long range variant is out. This is basically a truck that costs $69,000, about $10,000 less than the current all-wheel drive cheapest version. Basically, what you're getting a rear-wheel drive motor, not an all-wheel drive system. 350 miles of range, which is not bad, but you get less towing capacity, you get cloth seats, and no retractable tonneau cover, they call it, that goes over the back, and no useful the outlets in the bed are gone. So that's not happening either. So is it enough to move the needle? With the tax credit, you're down to around $62,000, which is fairly competitive. But you're up against the Rivian R1T and F-150 Lightning, which are very capable trucks that don't have the Musk and Tesla brand baggage, if you will. So hard to say if this cheaper truck will help them, which according to Cox Automotive, sales were halved of the Cybertruck in Q1 compared to Q4. So a long way to go there for them.
Pras, thank you. Josh, you're looking at a pickup truck?
I am. I've been talking to Pras. Well, I'm hoping Pras can maybe, he knows some people. He's a well-connected guy.
Yeah,
that's why we've been talking.
Get you some opinions about which one to get.
Exactly.
Oh, I can't wait to see pictures of Josh Lipton in his new pickup truck. We've got more market domination when we come back.
Occidental Petroleum and Chevron hit with a downgrade from Scotiabank. The stocks lowered to sector perform from sector outperform. Scotiabank also lowering its price target on each stock. So the note here, so on Occidental, they go to sector perform, so the equivalent of a whole Julie. The target is 40. They talk about a leverage position as being more problematic versus rivals due to the untimely acquisition of Crown Rock. They talk about how it's going to be tough for the company to outperform until the macro improves.
Yeah, and they talk about how that this is, in their words, one of the most oil-leveraged companies within our universe. I don't know if you've noticed, but we've seen oil prices go down, so that would be a negative potentially in this environment. When it comes to Chevron, one of the key reasons why investors hold these oil companies is because of the cash return to shareholders.
Send me a check.
Exactly.
Yes.
And the analyst at Scotia says, we think that Chevron has a higher likelihood of reducing their current buyback run rate from the recent annual pace in the coming quarters. Exxon has a higher probability of retaining that rate.
And what do they like, Julie? They go to hold on a couple names. What do they like? They like EOG Resources.
Right.
They go to sector outperform, so equivalent of buy. Fortress balance sheet.
You always like to hear that.
You do. You really do. While President Trump may have paused tariffs for many countries, sectors are still left grappling with the uncertainty his approach has brought. And one industry forced to navigate the constant change is beverages. And joining us now is Filippo Falorni, Citi VP, U.S. Beverages and Household Personal Care Lead Analyst. Always good to see you on the show. I think I think you know where I have to start here, Filippo. Got to start with tariffs, right? This fast-moving target. I'm sure you are getting all kinds of questions from your clients. They're asking you to make sense of tariffs. What's it going to mean as it ripples through your coverage universe? These beverage makers, what's it going to mean for their financials? You tell them what, Filippo?
Yes. Hi, Josh. Thanks for having me on. Yeah, look, the main issue for the beverage company is going to be the packaging side. So the aluminum tariff is really what is going to impact a lot of the companies. We've heard yesterday from Constellation Brands, which obviously also imports all their beer from Mexico, brands like Corona, Modelo Especial, Pacifico. But the good thing is that beer is included in USMCA, and therefore the liquid is actually exempt from tariff currently. But where they're actually getting the tariff hit is really on the aluminum can, and that tariff is still going on. So that is going to impact anyone that imports aluminum can. Obviously, the beer industry is clearly exposed, as is the non-alcoholic beverage industry, like companies like Coca-Cola, Pepsi, Keurig Dr. Pepper. They're all exposed to the aluminum tariff. And then the other question, still on the alcohol side, is potential retaliatory tariffs from the EU. Obviously, everything has been put on pause. But there was a lot of discussion earlier in March and early April about like the potential tariff on American whiskey from the European Union and the potential retaliatory tariff from the US on imported wines and spirits from Europe. So all those are on pause, but clearly still a lot of risks out there.
Well, and Filippo, then there's the other part of all of this, which is the effect it could potentially have on consumer spending. And we actually spoke to Bill Newlands earlier today on Yahoo Finance, the CEO of Constellation Brands. And here's what he told us about consumer demand right now.
Well, the consumer's concerned about a number of things. You know, we do a fair amount of research, Brian, as you would expect, on how the consumer sentiment is. And there's several areas. They're concerned about the pricing, costs of things, inflation. They're concerned about immigration, particularly consumers that have had friends or family who've been involved with issues around immigration. And how that's translating is that people are spending less. They're out less in restaurants. They're spending less on consumer goods and consumables. Fortunately, beer is pretty far down the list, but there's an overall concern in that community, less social gatherings. You know, people are getting together less. Those are beer moments.
And that was Bill talking to our executive editor, Brian Sozzi, this morning. So, Filippo, what do you make of that commentary and the effect that is going to have, not just on Constellation, but other companies in your coverage?
Yes, Julie, that's a very good point. And we are seeing it already in the data that we see like on a bi-weekly basis with scanner data, tracking consumer takeaway. And we're seeing generally a slowdown in a lot of different categories. And I tend to agree with the comments from Bill that you are seeing across the board. You're seeing a little bit more in beverages because those tend to be more tied to social interaction, social gathering. And so you're seeing a little bit more of that deceleration, but even in daily use category, like I cover also the household product sector, and you're seeing also a reduction in spending there as well. People are stretching the repurchasing cycle. They're only going to repurchase when they fully ran out of products instead of keeping a good stock level at home. So you're seeing it pretty much across the board.
Let's get to some names here, Filippo. So you mentioned Constellation Brands and their report. You're still at a neutral here, Filippo. Why are you at a neutral, and what would it take to get you more bullish on this one?
Yeah, look, we downgraded recently Constellation Brands to neutral. We were buy rated previously. And the main reason is what Bill was talking about is there's clearly been a slowdown in consumption levels across the beer category. And for Constellation, about 50% of their consumer base skews to the Hispanic population. And that part of the population has clearly seen even a further slowdown. Obviously, a lot of worry around the legal status of part of that population. But even, the part that is legally documented in the U.S., there's been a little bit more of a pullback compared to other parts of the U.S. population. So clearly, the U.S. beer business has slowed for them. Yesterday, they reported the first quarter of negative beer depletion. That's the volume metric after really growing high single digit for the prior decade. So it's a pretty big step down in their consumption. And look, we have to see how long that lasts. But as long as we see this environment being soft, I think it's going to be a bit more challenging for them.
Filippo, you don't have buy ratings on a lot of the alcohol companies in your coverage, but I believe you do still have one on Boston Beer. Why them? Why are they more preferred by you? Is it just because they're sort of in recovery mode, I guess, coming from a lower base, maybe?
Yeah, Boston Beer, it was a recent upgrade to buy. What we like about Boston Beer is that it's a little bit more of an idiosyncratic story in the sense that they have this new brand, Sun Cruiser, which they're launching currently. They're going national. And it's a big new launch. They're spending between 30 and 50 million in advertising. They also did a Super Bowl commercial. And this is really a vodka-based iced tea product, which was very successful. It was a very successful category last summer. Their competitor brand is Surfside. And so we are pretty bullish on this national launch. And they also, to your point, Julie, they come off like 3 years of really negative sales growth because they were cycling the hard seltzer boom from 2020 and 2021 when Truly was growing triple digits. And then all of a sudden, Truly fell off a cliff, and they didn't really have a product that could replace the growth of Truly. We are pretty bullish on this launch that is going to go national, and they're going to be fully national by the end of June. So we're pretty bullish into the summer.
Filippo, what about Brown-Forman? There's another name, of course, home of Jack Daniels, Filippo, but another name where you're neutral for now.
Yeah, like the spirits category has been a little bit more challenging even compared to beer. Some of it is the concern around like inventory levels, right? The difference with spirits is that spirits don't have an expiration date, and consumers really stocked up on a lot of spirits during the pandemic. So there's this kind of lagged effect of bar carts at home being full and the repurchasing cycle being very delayed because you can keep your spirits pretty much forever, right? And so that's really what is a bit of the concern on the spirit side, that it will take some time for the category to get better. And you also need the macros, similarly to beer, to get incrementally a little bit better to see the consumption level reaccelerate.
Filippo, always great to see you and to get those picks. Thank you, sir.
Thank you. Thanks for having me.
While wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.